we? Okay. Mana tadi I stop? Okay, financial year. So now it has been shortened from 6 months to 4 months. Okay, why? All right. The first thing is that because we know already when we audit financial statement, okay, it's already historical information. Okay, it's already historical information, which is like I would say outdated lah. Okay, we are talking about asset now. That is the information in the past. All right, so that's why if we like delay from the year end is 31st December, after 6 months only you complete the audit, then only perhaps in the July or August you presented to the members of the shareholders of the company. So it's like the third quarter already of the following year. Okay, so the information might be outdated. Okay, because one of the criteria under the framework FRS framework is to make sure that information is actually relevant and timely. Okay, so it means it's relevant lah, alright, for you to make decision. I'm sure you learn about when you want to make decisions, certain information must be relevant, it must be timely. Okay, because if it is outdated, information in the past actually is not relevant for you to use, okay, in order to make decision, right? So that's why to enhance the timeliness and relevance of the information within the financial statement, audited financial statement, okay, it has been shortened from 6 months to 4 months. So meaning now, whenever you do the audit, your year end is 31st December, hence the account must be keting sekejap. Okay, so the account must be audited latest by 30th April. Okay, all right. So these are the time frames. So during this is normally what we call final audit lah. Okay, final audit. Okay, because you do after post year end. Right. So during the final audit, if you don't have done your interim audit, then during the final audit, this is the time when you do your planning, your field work, and also audit completion. But of course, audit completions normally will be towards the end, okay, of the wrap up stage lah. Okay, the wrap up stage where you want to finalize what will be the final figure on the financial statement. Okay, all right. So once you have wrapped up everything, all right, the accounts has been agreed by both parties, then the account will be signed. Then you would have what we call this audit report date. Okay, the date of the report, right? So I'm sure you have come across whereby you pass the signing page to the signing page. That means I'm actually referring to the on the annual report. Okay, there is one last page of the audit opinion where the director signs a statement of directors, okay, declaration, statutory declaration report, and all those things must be either signed by CFO, board of directors, particular directors, and also auditors, okay, partner. All right. So if you notice, when they sign, right, they did not put the date. Okay, they did not put the date, so the date will be put later on. All right. So they just pass around. Okay, today they pass to the directors to sign the signing page only. All right, and then after that they pass to the partner to sign, and finally once all the sign they got the sign, then they will check, okay, on which particular date that all these people is actually physically present in Malaysia. All right, and then once they find those date, then only those date will be stamped on the auditor's report. All right, because sometimes not everyone on that particular day can, because they need to bring it to the company and then coming back to, so it cannot be done settled in one day. Okay, so that's what normally the process that happen in the audit firm. Okay, but of course at the end of the day they will check what are the date that all physically present in Malaysia. Okay, all right. So after the date that the accounts has been signed, okay, we need to know something happened, okay, to the company, all right, after year end, right, before the sign of the account, but there could also something happen to the company after year end, after the signing of the account. Could that events have an impact on the financial statement that you audit? Okay, could that impact on the financial statement of the audit? So today, under the audit completion, these are the things that you want to look at. Okay, these are the things that you want to look at. So let me share my whiteboard. Okay, so what happened is that, very important, okay, the timeline is very important. So this is the year end. Okay, so this is the date that you sign, date of audit report. And then this is the issuance. Issuance means the distribution. Okay, distribution, that means it has been distributed to the, because in the listed company, they distribute to the public, okay, to the shareholders per se and so on. Right. So now we are talking about events. Okay, the events could happen here. Could happen here during the course of the audit. Okay, or perhaps the course of the audit is done, okay, but it's just before you sign the account. Or perhaps the event could happen here. Or the events could also happen here. Okay, all right. Okay, so we are talking about event or events that happen post year end. Okay, post year end. But the question is that events, okay, these events, all these events, could it have an impact on the financial statement for this particular year end? Okay, because they are events that could have an impact. There are also events that have no impact. Okay, all right. And then what do we do as an auditor? Okay, what do we do as an auditor? So now we have to know what are the roles of auditor. Are you just see only, listen only, take note only, or we have to do something? All right, we have to do something, particularly when there is an impact to the financial statement. All right, because we want to make sure that auditors must have done their duty of care. So as an auditor, we have to know whether our task is just completed at the point of when we already signed the account or not. Okay, all right. So as an auditor, we have to know, okay, what are the procedures that we have to do. So basically audit procedures. Okay, do we need to conduct certain audit procedures or not? Okay, and then we have to assess, is there any impact or changes, okay, to the financial statement? All right, is there any changes required? All right, and then if there is a changes or adjustment, what do we do? Of course, when there is an adjustment, we have to consult the client. We have to get an agreement from the client. Is it a must or not? Okay. All right. So when the adjustment, okay, this is where you have to be careful. Okay. Sometimes the adjustment only required on the notes to the accounts. Okay, notes to account. That means the disclosure part. All right. Or perhaps you have also made changes to the financial statement. On the surface of the financial statement, it means you have to do certain debit credit, which is to the P&L item and also to the balance sheet item. All right. Okay, so we have to assess. Okay, so in general, when we're talking about completion, these are the things that we want to look for. Okay, apart from that, okay, apart from this, okay, as an completion, okay, we are also looking at items that involve a lot of judgment. Okay, involve a lot of judgment, which are contingency, estimates. Okay, contingency and estimates. So whatever involve judgment, going concern is also involve judgment. Right, going concern are also involve judgment. So apart from just now the event, All right, so the first one, what we're looking at is that actually the events. Okay, second thing, we assess anything or item that involve judgment in the financial statement. Okay, and finally, okay, there is a analytical procedure. Okay, this is final, final analytical procedure. This is actually to ensure completeness of your work on the financial statement. Right? Okay, so basically, when talking about audit completion, these are our main concern. Okay, these are our main concern because we want to make sure that whatever with things that could have an impact on the financial statement have been taken care of. Okay. All right, so coming back to completion. So you have contingency, you have estimates. Okay, so contingency is talking about liabilities. Okay, you also might have assets. Okay, so from accounting perspective, we practice prudence. So prudence means whatever that we predict we might have a liability exposure, then normally we capture that into our account. But for assets, okay, normally we don't actually might not even touch the financial statement. Or worst scenario, if we want to highlight to the shareholders, normally we just put in the notes to the accounts. Okay, all right. Contingency is liability where it might have impact on the financial statement. Okay, for instance, if you have a court case. Okay, court case, let's say sometimes court case happen for the company take 5 years. Okay, so 5 years, every year, you still have not come. When you want to close the account, still have not come to the final stage of the decision of the case. Okay, so you still want to know what is the outcome, and you predict there is an outcome of a certain sum to be paid, need to be paid by the company. Okay, for the liability that they are supposed to. All right. So in that case, perhaps we make some provisions into the accounts. Okay, but if you are to be the winning party, all right, supposed to accept to receive the amount of money from that case. Okay, if we know for sure we are going to get a certain amount, do we record in our financial statement? No, we don't. In fact, very rare, we also make some disclosure to the notes to the accounts. Okay, so it's different from contingent liabilities. Okay, because on the prudence basis, we recognize liability. Okay, we emphasize more on the liability. Okay, most important thing for every item on the completions, right, you have to know what are the duties of the auditors. So basically, audit procedures. Okay, question that will be asked most of the times is that you are given certain scenario, and then from that scenario, we might ask, okay, we want to audit this particular event. Okay, so what are the audit procedures that auditors need to do, and what documents or evidence that auditors need to do the citing. Okay, so basically you have to be familiar with. Okay, still sometimes it goes back to your understanding of the accounting records and accounting documents. All right, so we don't go beyond that. Okay, we just go beyond what you have learned. All right. So accounting records and accounting documents is very common. Okay, and then apart from that, we also look at correspondence. Okay, correspondence means letters. So last time in the old days, we have hard copy letter, okay, whereby everything is doing post, right? But now all these post material hard copy letter is like rare already. Okay, people are preferred to communicate through email. Okay, so meaning that now email would be your evidence that you need to sign. Okay, email is actually an acceptable correspondence, okay, that you would actually use as your evidence, okay, to support your opinion. All right, and of course, apart from that, we do have minutes of meeting. Okay, we do have contracts, depends, all right, or sometimes offer letter or agreement. okay, any documents lah, okay, that you use any documents that you use to validate the situation. Okay, all right. So that is actually very important. Okay, another thing is that normally you will communicate with the legal counsel. Okay, that means the lawyers of the company. Okay, because normally lawyers of the company knows better what is actually liability exposure that the company have, okay, for a certain particular case and so on. But sometimes they don't have any appointed law firm, okay, but they do have in-house legal department. So you will actually liaise with their legal department, okay, correspondence with regard to all those liabilities exposure. Okay, so contingency specifically refer to liability exposure that faced by the company. Okay, so that's why we have legal letter. Legal letter means we send a letter to the either legal counsel in the house or legal law firm. Okay, so that is with regard to the contingency. Commitment, as I mentioned just now, assets part, okay. So very rare lah, okay. Auditors normally capture that in their financial statement, very rare. Okay, but if we really want to disclose, then perhaps we want to disclose in the notes to the accounts. Okay, for instance, like what's this? Sometimes you review the strategic planning of the company, and then when you review strategic planning of the company, you look at that they have an intention to do an expansion, business expansion. Okay, business expansion. Hence, they have an intention to invest a certain amount of money in their expanding their capital assets. Okay, so of course, from the other point of view, you increase your assets, increase your capacity, but of course, on the other side, it will also increase your liability exposure indirectly. Okay, but since it is still in planning stage, so most of the time, if you think that you want to disclose, because sometimes it will also be a good information to the members and also investors to know that information, because it might also increase the values of the company, because they know that the company is expanding, they have money to grow and so on. Okay, so from the other angle, it's a good information. So it is actually allowed for the company to disclose to if they want to do it. Okay, but of course, as an auditor, you have to verify lah. Okay, you have to verify that information, all those things have gone through a proper channel of deliberation. It has been deliberated in the minutes. In the meeting. Hence, you look check the minutes lah. Okay. Then if let's say there is an agreement has been signed whatsoever, MOU ke, MOA or whatever, and then you go and verify, okay, the document, right? So that is with regard to capital commitment. Normally disclosure only required if necessary. Okay, for estimate, this is actually the high risk area. Okay, this is actually high risk area. Why I say high risk areas? Because this is where one angle where it can actually lead to fraudulent in financial reporting. Okay, fraudulent in financial reporting, because it can be one of the tool to do earnings management. Okay, what is earnings management? Okay, earnings management, from the word itself, earnings is actually your profits lah, okay, or your revenue, your income, whatever that you earn, okay, by the business. And now you are managing your earnings. Okay, you're managing your earning into a proper recognition. Or perhaps what you did is that you manage lah. That means perhaps this year you want to recognize more earnings, but next year you want to recognize lesser earnings slightly, for whatever reason. All right, or perhaps you think that this year you have so much of sales, so you don't want to recognize all your sales this year. Okay, you want to park some of your this year revenue to next year as a buffer. Can you do that? Okay, so this is where the platform of the provisions account is actually being done. okay, provisions account, okay, is actually being done in such a way, okay, to use for the estimation or earnings management. So that's why auditors, the final things they would actually look at the judgment of the management. All right. So first thing they will look at is the valuation. Okay, the valuation. Nowadays, people standards are talking a lot about fair value. Okay, so after you have done your audit, because completion by right, more or less you are almost done lah with your audit, right? Okay, so you can actually see how much different your audited before sign audited financial statement to the original management account. All right, so from there you can actually see because you have done the audit, so perhaps based on certain findings, certain assets need to be valued and certain liability need to be valued. Okay, so what happened is that the fair value is actually in question. So, okay, so now come to audit. As an auditor, what do you need to do? Okay, as an auditor, when you audit the fair value, you first must find out what is the basis for you to come to that value. Okay, again, all must be supported with the right, okay, the right evidence. Okay, the right documents. You cannot say that, oh, I dream that the property for that particular property, the value is, let's say, 2 million. Okay, what is your basis? No basis. You just plug the figures from the sky. Okay, in audit, it is not trusted evidence. Okay, so what do? Normally, we will check the market value. So how do we check the market value? Sometimes we might even go to the perhaps mudah.com. Okay, you go to that particular area and then you assess properties in the area, how much is the value. Is it more or less at par at the market value or not? Okay, all right. And then perhaps you ask the valuer. Okay, authorized valuer, because we do have authorized valuer that have the expert of the actuaries and so on for them to estimate what is the valuation of that particular properties and so on. Okay, so whatever it is, it must have basis. Okay, it must have basis, and then when the record is actually being done. So remember, when we're talking about FRS, you have the level of first recognize kan. Okay, whether to recognize that as an to recognize or not to recognize. If you want to recognize, then how you want to recognize? You want to recognize as asset ke, liability ke, income or expenses. Okay, so once you know the category, then next will be measurement. How much is the value you want to recognize? Okay, so if you know how much is the value, then you do your measurement lah, proper measurement, how much is the value to be recognized in the respective account. Okay, and of course, the last one is the presentation and disclosure. Okay, do you need to present or do you need to make additional disclosure or not into the sets, the notes to the accounts? All right, so as an auditor, we know these are the process that clients must do. So if client did not do the hands, we have to take into account of adjustment. Okay. So normally when we audit for adjustment, all right, very important assumption. Okay, so if let's say some question asks what are the audit procedures for you to check that particular estimation. So definitely the first thing is that to understand what is actually the estimation item that you need to estimate. Okay, and then how it is actually being estimated. Hence, it will go to the policies and procedures. Okay, because sometimes certain thing needs authorization. Okay, so is it authorized or not? I mean, has it been tabled in the minutes in the meeting or not, and so on. Okay, so that's with regard briefly in term of estimation. Okay, events this is subsequent events. So if you see here, it have many stages So this is the one that I highlighted just now. Events occurred between balance sheet date and the date of the report. Okay, so meaning what? Meaning is actually the one that refer to before audit report here. Okay, whatever before the report, what are the responsibility? Okay, what the responsibility of the auditor, what you are supposed to do, what you are supposed to confirm with particular client. Okay, what happened? All right. What is auditor's obligation? If happened after you sign, but before it's being issued to the public, or perhaps happen after issuance of the public. Okay. There are many things happens. Right. So what do we do? As an auditor, also the same thing. Okay, of course, if it is a big important decision and so on, it will be discussed in the board minutes. Okay, board meeting. Hence, you have to cite the board minutes. Where do you get these board minutes? From the secretarial practices. Okay, because they handle board of directors, right? So whatever board meeting they handle, so all the minutes is actually prepared by them. Okay, that's one. Second, you review interim audit. Interim financial statement. What is interim financial statement? Your year end is 31st December, kan? This is your year end. So, let's say you come and audit in the month of March. Okay, March, this one is 2019. So, you come in the month of March of 2000. Alright, so what do? You get financial statement at least for the first 3 months. Okay, you get financial statement for the first 3 months. Why? Because you want to see, is there any significant items that being recognized or not? Very glaring items. Okay, or reversal that being done. Okay, reversal that being done, meaning that before you end, you do the posting. After you end, you reverse. Does that happen? Yes, it happened in reality. For whatever reason that they want to do it. Okay, all right. So, this is what we are looking at. Okay, interim financial statement. Okay, and then if there is any changes in the liabilities or whatever, okay, the notes to the accounts and so on. All right, and any unusual accounting adjustment made after balance sheet date. Right, you backdated. Okay, sometimes you change the depreciation policy. Suddenly change depreciation policy. Why is that happen? Okay, so this is all related to the events that crucial that need attentions from the auditors. Okay, what happened if it is after balance sheet date? Okay, and then it happened before you sign the account. Okay, so your concern is number one, do you need adjustment? If no adjustment, do nothing. Do nothing. You can actually end up do nothing. Not everything that happen have something to do lah. Okay, sometimes you check maturity level, then okay lah. Nothing significant impact. Okay, so first we have to see, do we need any adjustment? Second, if there is an adjustment, is it just adjustment on the financial statement or is it just adjustment on the notes to the account? Okay, because sometimes you just might require notes to the accounts. Okay, but then no need adjustment to the financial statement, but sometimes just financial statement. Okay, so we have to assess the situation. But if it is happened after the sign, okay, you already signed the account and suddenly you find mistake. I mean, mistakes or errors has been highlighted. So what do you do? Okay, now if last time everything has been printed out, annual report 100 pages are all being printed out. But now with the beauty of technology, no longer we just receive CD only. Okay, so save cost lah in a way. But how you want to address? Okay, the CD has been printed. There are adjustments, which is accounts inside the CD is not actually tally to the latest accounts. So what do we do? Okay, so that's why you have to see, assess materiality is significant or not. If let's say adjustment required, okay, or changes required to the financial statement or perhaps to the notes to the accounts, okay, you would actually sometimes receive excerpt Okay, additional attachment, hard copy lah, 1 or 2 pages, given together with your CD of your annual report just now. Okay, so you can see that addendum. So this page should be read to replace whatever page number inside the annual report. Okay, so that is actually also happened in reality, where after all the audited account has been verified and then checking has been done and so on, so on, still something happened. You want to make adjustment. Okay, and client agreed, client agreed. And then all this could be done, but it's just that how you want to do it. Okay, so that is with regard to the subsequent events. So we have to know the implication. So again, on the auditor side, it's also involved judgment. So you have to decide. Okay, so that's why this particular section on audit, when talking about all those just now, right, is always involved or done by the senior, because senior is the one that have more experience. Okay, more experience, they can make a judgment, a good judgment, right? Which of the actions that need to be taken by the auditors. Okay, so that's with regard to, okay, analytical review. Okay, analytical review, if you recall, how many times we do analytical review in an audit? How many times? 3, Okay, first time is when? Prelim, kan? Remember or not? Your prelim analytical review. When actually you do your prelim analytical review, this is normally during planning. Is that different from the final analytical review? It is different. Okay, why different? This one is unaudited management account. This is 2020. This is actually compared against audited account 2019. Okay, all right. So one is unaudited. Basically, this is what? This is raw financial statement, untouched. Okay, untouched financial statement, which is basically you just take at face value, whatever given by the client, you straight away compare to the last year's client's figure, okay, based on the 2019. Then you make comparison. Okay, so sometimes before that you have to take identification of the account is actually similar or not. Okay, because sometimes if it is a existing client, okay, normally classification sometimes is already standardized, but sometimes for some reason audit purpose, compliance to FRF purpose, we do reclassification. So when we compare, it has to be apple and apple. Okay, all right. So prelim is actually to assess an overview of what changed, okay, from last year of the audit. Okay, all right. So that is the first stage of analytical review. Second stage of analytical review, if you remember when you do your, okay, you remember you do your field work, every section you make comparison kan at item level. Okay, for instance, you have sales. So when you have sales, sometimes you break down local sales, export sale. Okay, what are the item? Current year, last year. Okay, you compare. Okay, what are the changes and so on. And after that, you do ratios. Okay, so you do analysis, because ethical procedure not only compare last year and this year figure, you also do whatever ratios lah. Okay, ratios analysis. Right? But most importantly, when field work, you do based on item basis. So it's more detailed. Can you detect errors or fraud or not from doing analytical review in fieldwork? Do you think you can detect?
Yes.
Maybe.
Yes. Yeah, you can. All right. Because remember, you have to understand the causal relationship. Okay. Because we know that when we do sales, it has to be linked to account receivable. Okay. So sometimes you detect that sales increased by 250% compared to last year. Okay. But when you do the account receivable, increase 10% je. Make sense tak? Okay, so you must be able to see the causal relationship. That means you cannot just see. Of course, I said you do detailed ethical review for each item, but you also have to see the relationship. Okay, and then from one item to another item. So in a way, you can actually tell stories lah what happened in the business. Okay, so this is what happened in the fieldwork. All right, ethical review. So much detail, all right, and then much thorough lah, and also you still can detect any abnormalities. Still can detect. Okay. That's why if you recall last time when we talking about this strategy, this is also considered as one of the important audit procedures. Okay. The final stage of ethical review is during completion. What's the difference? Here, you almost come to the end of the audit. So meaning, the current year figure is already almost like, I would say, audited lah. Almost done, right? Okay, so more or less you have audited all the items. Okay, and now you're comparing to last year, which is also audited. Then from here, you can actually evaluate whether the financial statement is actually making sense or not. Okay, is it okay? Is it looks okay? Is there any funny things happen? Okay, all right, so that's one. Second, whatever story here, more or less should tally here lah. Okay, and also to identify any item that you're missing to audit. Item that needs to be audited. Okay, because sometimes when you go through everything, you forgot to audit fixed deposit. Okay, there's one line, a few lines or whatever lah, okay, inside the trial balance and the balance sheet. Forgot to, because you cannot explain the explain it, the increase, decrease, why and so on. So you cannot explain. So that is actually why we do final ethical review. Okay, to assess the overall story. Is it jive from the beginning until the end of the final ethical review? Okay, and of course to ensure that all the items that need to be audited must be audited.
Madam,
Yes.
is analytical review being performed to all item in balance sheet and also profit and loss?
Normally significant item, balance sheet all item. Normally balance sheet ni all item. P&L sometimes depend on major item. It depends lah. How many items do they have in the P&L? Because sometimes they have many items but small item kan. So maybe they just pick up the important item, but sometimes they will just do certain item like certain level lah, revenue, cost of goods sold, gross profit, and then expenses pun maybe at category of the expenses, operating expenses, financing expenses, whatever. So P&L normally not that thorough lah. I mean not by item, line by line. No.
Okay.
Unless you are small company kan. Kadang-kadang company you small, yang you audit tu small je, trading company. And then it can be done, it's doable, then you just do. Okay, because nowadays it's much easier lah because you use Excel kan, and sometimes all those can be imported. Okay, any other question? If you have any question, just pop up question. Okay, so that's ethical review. Okay, going concern. Alright, going concern is also important. Alright, going concern is also important. Sometimes the accounts is all okay lah, tak ada issue, nothing issue, all follow internal control are in order, alright, no fishy things whatsoever. Okay, but somehow you have to assess going concern. Okay, there are certain key area that you have to look at. Number one, normally will be profit. Is it making profit or is it making loss? Okay, the trigger for the going concern if they are making loss for consecutive 5 years. Okay, 5 consecutive, 5, tak semestinya lah going concern I'm just highlighting lah because you have to see from a combination of few items a few points lah, right? So but the normal indicator that we found that actually lead to the going concern issues is their business profit actually not making, they're making loss. Okay, for the past 5 years they're making loss. That's one. Okay, and then sales to increase but at decreasing rate. Okay, every year increase 10%. Every year increase, there is a growth of the revenue, but the last year increased by 5%. Okay, the year before increased by 7%. The year before increased by 10%. So the amount of increase is actually reducing from 10%, okay, in the third year ago, now become increase only by 5%. Okay, so that means in a way it implied what? It's impliedly telling that something sales is not making in a way. So again, that is one reason. Second item that you should have look at is the cash flow. Okay, if they sometimes they made sales but they did not have cash flow. Okay, they are poor on the cash flow management, or perhaps they misuse for whatever reason, or perhaps they incur a lot of asset acquisition and so on. Okay, all right. So cash flow is also another angle that you would actually look at. And then another one is accumulated profit, accumulated loss. Okay, company making loss for past 5 years, and then the accumulated, the retained earnings, all right, normally retained earnings can, is it positive or is it negative? And you further check, it is actually accumulated loss. Okay, another indicator, the key person inside the business gone, pass away ke, whatever lah, gone ke, and so on. Okay, so when he or she gone, no one's know about the business, no one's know how to drive the business. So you can see slowly the business is actually diminishing. Okay, another reason, outdated facility. This one happened many already in reality. Number one, Nokia. Okay, overnight Nokia out of market. From being number one in the market share, overnight out of market because of the introduction of Samsung and iPhone at that time, smartphone. Okay, so you can imagine at that time, the day before you are so great, you are number one in the market share, top in the market share. The day after, you are no longer, you are out from the market, you close shop. Okay, another example is Kodak. Okay, last time we use tak tahulah you all ni tahu ke tak, film. Okay, when you have camera, you have film inside. Okay, so normally we use we call it Kodak lah, because that is the big giant company at that time that produced the film for the camera. Okay, so at a certain angle, people no longer use camera. Camera become digital, so no more film. That's one. And later on, camera is integrated into handphone. So people will no longer need for the camera. People will no longer need for the film just now. Okay, so what happened to the company? Out of business. Because you refuse to change. Okay, so that's why understanding the business in the first stage too is actually very important. So you also have to know what is actually going on in that industry. Okay, you have to know. That's why general knowledge is actually very crucial. You have to know. If you're auditing this particular kind of industry, that's why now if you go to work in audit, especially before, you go by industry. So in a way, you know, in that particular industry, what is actually the latest, the in thing, so on, so on. Okay, so you'll be able to know. Because any wrong steps, it can actually end up into going concern. Okay, so these are some of the areas that we can actually look at to assess the company is actually have a going concern or not. Okay, other than that, of course, external matters such as new legislation. Contoh, example, okay, let's say Maxis, license, from 3G to 4G, 5G, or later you move to 6G, whatever. Okay, one particular year you did not get, you not be able to get renew your license to the higher level of G. Government did not pass you, did not authorize you to get the license. What happened to you? Also, overnight, you used to be so big, you used to be steady in your performance, income, and so on, but because of the license being retrieved, you lost your business. So what happened? Okay, same thing like Asia, overnight pandemic, okay, totally cannot fly. Domestic, overseas, you can't fly. You see how much is the market value of the Asia now? Okay, less than yesterday 10 cent. Now it's 10 cent only. Only. Almost going into apa PN 17. Okay. But now we open up the market, open up the domestic fly and so on. Now the shares start increasing. Or else it might end up into business cannot survive. Okay, so you have to be able to see how the changes in the environment, external environment, also could have impact on the going concern of the company. Okay, and other than that, defaultment, cash flow tadi lah, when you have cash flow problem, you default your loan payment, then also inability, never pay dividend to your shareholders. So again, right, another angle, trigger point. Restructuring is also another point of company is actually having problem. Okay, debt, especially debt restructuring. Right, debt restructuring from short term into long term. Okay, right, you restructure your bond, you restructure your suku. That is also another angle showing that you actually company has a problem. Okay, so that's why I really emphasize on understanding of the business. Okay, it's interesting. In fact, now even when you ask where do you work, people sometimes you ask people where do they work, what they do, and so on, so on. So I will just ask, okay, what actually you do, what the company do, oh, company do like this, and so on, so on. Okay, interesting. From there you can actually from risk mindset perspective, you can actually see, oh, these are actually the risks of the company. Okay, these are actually, I mean, the nature of the business is like that. So if something happened to that, then actually they will be out of the business. So that is actually how you assess. Okay, so when you do the going concern assessment also, somehow the understanding of the business also would actually help whether they have the problem of going concern. Okay. Uh, so if they have any, of course lah, you have to decide with the clients lah. Okay, how would actually you do that? Because sometimes you put disclosure, sometimes you might change your audit opinion. That means you put up, you have a qualified, but you have emphasis matter. Okay, which is part of the key audit matters lah. Okay, part of the key audit matters. Sometimes the things might have impact on the financial statement. All right, but sometimes no impact at all. So it depends. So you see, when it comes to the completion, it all depends on the context of a particular scenarios. Okay, last but not least, disclosure. Okay, disclosure means you have to check lah. Okay, you have to go through. So this one, your understanding of the FRS is very important because you have to know is all things that need to be disclosed has been disclosed or not. Okay. Management letter, this is if they have a problem in the company, especially when they have internal control problem. Then normally you will compile all the witnesses and you issue letter lah to the company. Okay, and normally when you have dispute, you will talk to a committee. Other than that, this is management letter. Example of management letter when you highlight internal control witnesses. Okay, all right. That's in general what you are supposed to know for audit completion. Okay, any question?
Madam.
Yes.
I have a question about subsequent event.
Okay.
You mentioned about reversal. Can you explain a little bit or perhaps maybe give us some example?
Reversal. Maknanya reverse adjustment lah. You nak tengok example yang adjustment Okay, kita tengok activities You check in the WhatsApp, I already upload. Mana pula I letak I punya? Oi. Okay, let's do the exercise. You nak cari yang tu kan, reversal. Asyik kena hijack mama apa. Asyik mama kena hijack. Okay, reversal kita tengok contoh we look at the example. Okay, we look at this one lah. Let's try to look at this one. Alright. I give you all 5 minutes to read the 23-27. Exercise on the 23-27. We have few items. Okay, this is all about events lah. Okay, events that happen. So how will you handle all this thing on the financial statement? For year end 31st December. Okay, baca dulu. Apa yang belum baca dulu. Okay, done? Alright, let's look at the first scenario. Okay, here you have your financial statement. Okay, financial statement. Year end is 31st December. Okay, 2019. Alright, okay. So item number 1, the company's financial statement did not include an accrual for bonus earned by senior management in 2019 but payable in March 2020. Right, meaning asset financial statement 31st December, okay, inside accruals tak ada bonus ni tadi. Okay, dia tak accrue for 125. How do you discover? When you check interim financial statement, you come across that. Okay, bonus paid. Okay, bonus paid for 2019. So by right, asset year end, this is liability, right? Okay, this is liability of the company that they know that this is supposed to be incurred in regards to the 2019 but has not been captured in the financial statement. Okay, so this is what you are supposed to capture. So how you make adjustment? So basically you will debit your expenses, okay, your P&L, and then credit your accruals lah. But this will be financial statement for 31st December. To adjustment. Okay, alright. Tadi question about reversal Siapa yang bertanya tadi? Saya bila buka ni saya tak nampak siapa yang bertanya.
Saya, madam.
Apa tadi soalan? You tanya pasal reversal kan? Bila berlaku, when reversal will happen, right? Okay. What happened is that, like this some company, what happened, in year end, macam ini, like this, in this situation, they did not capture. Okay, but some company, what happened, in as at 31st December, they made provision. Debit expenses, katalah 500,000. Credit accruals, 500,000. Okay. Suddenly, right, after year end, when you check interim, you notice that they made a reversal. Okay, they reverse back this entry. Okay, they debit accruals, 500k. Okay, credit expenses, credit P&L which is now become income lah and similar, right, on the credit side, right, 500,000. Is that an issue? Okay, it is actually an issue for auditor. Why? Because here, if you record this in the current, in the 31st December 2019, meaning it will increase your expense by 500,000. So meaning it will reduce your profit by 500,000. Okay, but the moment you make this entry, what happened to the company? All right, now you actually increase your income by 500,000. Okay, so this is one of the mechanism of why people play around with the accruals and provisions. Okay, so normally auditor will ask, what's the purpose of you make this one? If later you want to reverse, then as well no need to do the provision. No need to accrue for it because you know for sure later you just reverse it out. Okay, so that's why end up sometimes we take this adjustment out. We reverse in the same year, not in the, so it's set off lah. Okay, it's set off. Okay, so that's why after year end, sometimes we go through the adjustment made by the client, reversal made by the client, right? So if we think the reversal made by the client is unnecessary, okay, then in the first place, remove that entry for during that financial year end. As well, no need to do that entry in that particular financial year end. That's what happened. Okay, is that clear?
Okay, madam.
You want to ask the question? Okay, so we always assess this. right? We assess this. So during the interim, sometimes when we check interim financial statement, we can also detect this. Okay, we can also detect. That's one area. Sometimes when we scrutinize journal adjustment, journal entries, also we can detect. Okay. Alright, number 2, equipment originally costing 725,000 that was fully depreciated with a remaining residual value of 60,000 was sold for 85,000. The purchaser agreed, okay, to pay for the equipment by January 2020. Okay, what happened here? Okay, it has fully depreciated. So now the net book value is 60,000, which is sold for 85,000 on December. Okay, all right. So the difference of the gain on disposal would be what? 25,000, right? Okay.
Yes.
So is that any adjustment required? How do you want to do the adjustment? Okay, how you want to do the adjustment? So practically, what happened is that here, okay, it's just that the gain on the disposal lah, you are right. That means the payment, fine. If the payment received in the following year, hence, right? How you want to capture? Okay, so if it is taken up in the following year, by right, it should not be captured in the financial year end 2019. Okay, that's one angle. Another angle, possible answer also. Sometimes you might say that no adjustment required because the amount is not that material. If you are given the maturity level, then you can do that. Okay. All right. So in general, when answering all these questions, is apply your assumption. Okay. But of course, you have to say it out loud lah. Okay. What are your assumptions? Okay, the third one, based on the close examination of the client's age, accounts receivable aging, okay, the auditor determined that the management allowance for bad debts is overstated by 44,000. Okay, so we can say that it might not be material, but if it is material, then of course we have to make adjustment to the valuation, okay, of the account receivable. Okay. And then the number four, expenses totaling 52,000 associated with the maintenance of equipment were inappropriately debited to the equipment account. Okay, so ni daripada supposed to go to maintenance, which is expenses, but it goes into asset account. Adjust ke tak adjust?
Adjust.
Adjust, because it's a different account, right? Because one is balance sheet, another one is P&L. By right, it should go to P&L. Okay, so this one might be misrepresenting the item lah. All right, misrepresenting your assets. That means you overstate your assets, understate your expenses. So adjustment. So you can say on that basis, adjustment required. Also can. Okay. Expenses totaling 52,000 associated with the maintenance. Itu dah. Number 5. Marketing expenses 43,000 were incorrectly classified as a cost of goods sold. Adjust ke biar?
Adjust.
Adjust. Why adjust?
Because the expense should be after the gross profit.
Because it is operating expenses, and then in fact if you put in the cost of goods sold, it will misrepresenting your GP margin. Okay, sebab tu kadang-kadang bila kita, when we do the calculation of GP margin, right, we compare last year, this year, why this year, that also sometimes how you find out the errors lah. Okay, because now it's like overstated your cost of goods sold, right? Okay, so it will affect drop your GP margin. So in a way, when you do your ratios in the field work, you might actually detect there are some mistake that capturing the cost of goods sold happen. Okay, so that is how macam mana nak cakap, maknanya audit ni you have to look from all angle lah. So that's why your accounting knowledge is actually very crucial. Understanding your account, you understand the accounting, debit, credit, impact and so on. Okay, last but not least, the company received new computer equipment on January 3rd that had been ordered and shipped FOB shipping point. Blah, blah, blah. No entry has been recorded for this purchase, which was financed by a long-term note payable due in full June. Due in full June 30th. What do we do? Dia tak ada amount. So, what will be your decision? Of course, in the amount material, you might want to capture based on prudent basis. Okay, it's a liability, commitment for you to purchase. Alright, commitment for you to purchase. Hence, it reflect your liability. Therefore, if you know that for sure in future you are going, and then in fact it's already noted that it will be financed by long-term note payable. Hence, you already have committed to a certain commitment. Okay, therefore, it reflects your liability exposure. Okay, so on prudence basis, you might want to capture or adjust to your financial statement. Okay. I'm sure some can follow, some cannot follow. Okay, but again, that's why you have to strengthen your accounting knowledge. Okay, the impact, means you have to first to understand the nature of the transaction. All right, and then of course, debit credit tu memang you really have to know the impact. Okay, depends on that scenario. What is the impact on the asset ke, liability ke, expenses ke, income or whatever. Okay, that's one. And then you have to know like, is it overstated or understated? And then of course you have to know the debit credit. Okay, and then of course you have to know the nature of the transaction lah. For instance, like what does it mean by long-term note payable? What is the implication? Like just now, maintenance of equipment compared to equipment account and so on. Okay, all right. So if you have this kind of questions, all right, that's how in general that we would actually answering it. Okay, that means first you have to say like in this question, is it need to be adjusted or not to be adjusted? Okay, and then supported your answer by saying, if you adjust, why you adjust? So justify your answer clearly. Okay, and if you say no adjustment, then also justify why you think that it is no adjustment required. Okay, because normally marks will be given first, your first decision. You have to state adjust or not adjust. Okay, if you're right, then you get marks there. But the justification is where you will get more marks. Okay, more marks given for your justification. So that's why it must jive lah. Okay, whatever your decision and also your justification. Okay, any question on that exercise? Do we have time? Okay, 3 more minutes. All right, just a quick one. The audit manager on the engagement for the past 3 years should stop 2 years back. Okay, so you see here the points here. All right, this is a company that actually online company. Okay, marketing, online marketing, advertising, digital marketing. So difficulty establishing loyal client base. This is one trigger point. Okay, and then in review of the current year, operating loss for the past 3 years, another trigger point. And another trigger point is working capital ratio declined from 1.2 to 0.9, the third point. Okay, so by reading this, I know already it's talking about going concern. Okay, all right. And then they're planning to go for debt financing. All right, not yet secured in financing with a bank. It shows what? Cash flow problem. So 4 trigger points. Okay, 4 trigger points. And then they aggressively pursuing new advertising contracts and plan to increase advertising revenue by 20%. Okay, all right. Okay, so here it's all issues about going concern. So number A, according to the auditing standard, what's the auditor's obligation to consider whether the client can continue as going concern or not? So you have to know lah from the just now, we already know that as part of the audit completion procedure, auditors have to assess going concern. Okay, the state of the going concern of the client. So that's the first answer. Means standards already mentioned, you have to do the assessment. Okay, and then assuming management is using GAAP, okay, what time period is the auditors required to consider the client's ability to continue going concern? Okay, so normally in our case, right, we actually assess for the next 1 year. Okay, for the next 1 year, meaning if year end is 31st December 2020, so that means can the company survive at least for the next 1 year, 12 months until 31st December to 2021. Okay, so we have to assess, right, for the at least for that 1 year, can the company assess or not? If cannot, then that's where your change to your audit report lah. Okay. All right, what factors to discuss relevant for the going concern assessment? Okay, so this is where the 4 triggers point just now. All right, which you should actually put inside your answer. Okay, to show that these are the trigger points that actually indicate the company is actually having going concern. Okay, all right. So what responsibility of the auditors to evaluate management plan? So normally company would have a plan, all right. So you have to see lah. Like here, their plan is to do advertising contract and advertising revenue increase. So what is actually their plan? Their plan reliable ke tak? Okay, their plan workable ke tak? So that's where you make your judgment. Okay, and then you make your conclusion lah. And of course, you put in your working paper. Okay. All right. So in general, these are kind of the questions that can be come out if we are talking about audit completion. Okay. So it's regard to the specific item lah in the completion. Like just now we have subsequent event, we have contingent liability. Okay, we have